find out what the largest trade groups in real estate had to say to the Federal Reserve in this week's market report. I'm Tom Grant. I'm a real estate agent with the Principal Team. Just this past week, the biggest trade groups in real estate, the National Association of Realtors, the Mortgage Bankers Association, and the National Association of Home Builders all sent a letter to the Federal Reserve. They wanted to convey what they call profound concern that, and I'm reading from the letter here, that ongoing market uncertainty about the Fed's rate path is contributing to recent interest rate hikes and volatility. I'm going to continue reading from the letter a little bit. They go on to say that mortgage rates have now reached a 23-year high, dragging mortgage application activity, down to a low last seen in 1996. So basically they're saying that uncertainty is causing interest rate hikes, and higher interest rates are causing buyers really to pull out of the market. There's a second piece of this letter that is fairly technical, but I want to go into it and explain it a little bit. Basically, you may know this already, and I'm not an economics expert, but it's pretty simple. Mortgage interest rates are very correlated to 10-year Treasury bill yields. So the U.S. government issues government securities, things like bonds and treasury bills. And they do this to fund our government. It's another way, aside from taxes, that they can bring in money. But they pay people who buy these securities interest on the securities. So as the yields, what they're paying on the 10-year Treasury bills, go up, so do mortgage rates. Typically, there's a spread between the T-bill, the 10-year Treasury bill yield, and mortgage interest rates that's about 1.5%, maybe 2%. That's typical historically. And really, they rise and fall, if you look at graphs, almost completely in unison. What's happened now is that spread is higher than it's ever been. The letter says, today, the spread between 30-year mortgage rates and the 10-year Treasury yield is at historically high levels, signaling deep-seated uncertainty about where the Fed is headed. They use that word uncertainty again and again in this letter. I'm going to read another part, and this is a little bit long, so forgive me for reading it, but I think it's interesting. They say, the difference between the current spread and the long-run average indicates mortgage rates for homebuyers across the country that are at least 120 basis points higher than they otherwise would be. In other words, the uncertainty-induced mortgage to Treasury spread is costing today's homebuyers an extra $245 in monthly payments on a standard $300,000 mortgage. Our prices here are pretty high compared to a lot of the country. A lot of people here are getting mortgages much higher than $300,000. So that's costing us here in the Denver area even more than that $245 per month. Most people. Some people are getting a $300,000 mortgage. Further rate increases and a persistently wide spread pose broader risks to economic growth, heightening the likelihood and magnitude of a recession. So the letter writers here are not just concerned with housing, they're also talking about the economy in general and saying that if the Fed continues to raise rates like they have, we've had 11 rate increases since last March 2022. March 2022, not March 2023. But we've had, 11 rate increases, the most significant, peak, the steepest peak in interest rates ever in our history. So that's a little crazy. They go on to say, furthermore, the leading source of inflation in recent months has been increases in shelter costs. So think about it. The Fed is is raising interest rates to try to tame inflation. What the letter writers are saying is that it's kind of having the opposite effect on housing costs. It's raising housing costs. They say in the August CPI report, Consumer Price Index report, consumer prices were up 3.7%, while shelter costs were up 7.3%. So shelter costs, housing costs, are going up faster and higher than other costs are going up, partially or in large part because of all this uncertainty about the Fed's plan. In July, shelter inflation was responsible for 90% of the gain for consumer prices. The most effective approach to tame shelter costs and assist on the broader inflation fight is to facilitate the construction of attainable, affordable housing. And we've talked about this before. We need lots more houses, not just in the Metro Denver area, but throughout the country. And we're really in a housing crunch. We need a lot more homes and affordable homes. And what they're saying is that's one cause of high inflation. They say sustained wide spreads or further increases in interest rates make this economical goal, the goal of attainable, affordable housing, more challenging because it really hurts builders. They say it limits lot development and home construction, and they also say it prices out millions of households from the goal of home ownership. So they're not just talking about the housing economy, they're really expressing concern about the economy as a whole, and they think one result of more stable interest rates would be more affordable housing. So how do we get there? How do we get rid of what they've called, they've called it out in this letter 3 or 4 times, uncertainty. The letter writers specifically make some demands here, and I'm going to read those to you. They say, we strongly urge the Fed to make 2 clear statements to the market. So they want the Fed to come out and actually say these things. They say they want the Fed to say that the Fed does not contemplate further rate hikes, and they want the Fed to say they will not sell off any mortgage-backed securities until and unless the housing finance market has stabilized and mortgage to treasury spreads have normalized. So they want that spread to get back to more normal levels, 1.5% to 2%. Percentage points rather than this big spread we're seeing now. The letter also explains that housing makes up a huge part of our GDP. It depends who's doing the calculating, but it may be about 16% of our gross domestic product. So right now, things are kind of frozen. Not a lot of people are buying and selling homes. People who need to move are moving, but a lot of other people are sitting on the sidelines. They're waiting for interest rates to come down before they make a move. Here's what I think. I don't think the Fed is ready to stop using interest rates to try to tame inflation. I think a lot of the reporting that I've read says we probably won't see an interest rate hike in November, but we may very well see one in December. Eventually, the Fed may come out and make some statements like these, the ones requested, but I think we won't see that until we get into the new year. The Fed meets at the end of October into November 1st, I think. They could make a statement then, but I really wouldn't count on them coming out and saying they're not going to hike rates again. If you want to find out more, if you want to read the letter and find out what's happening in our local market this past week, take a look at our market update, our written market update. There's a link to it in the description. Take a look at that. You'll get some details about what happened this past week locally. And we also linked some interesting news reports on the internet that we like. If you have questions about buying or selling a home, contact me anytime. I'm happy to help. Again, my name is Tom Grant. I'm a real estate agent with the Principal Team. Thanks for watching. Have a great day.